After months of waiting following last fall's government shutdown, we finally have a wave of delayed economic reports hitting all at once. The government has now released updated data on home construction, home sales, GDP, and the Fed's preferred inflation gauge, the PCE Index, giving us a much clearer picture of where the economy and housing market truly stand as we head into the spring buying season. Good afternoon. And just like that, we're wrapping up February and officially closing out the first 2 months of 2026. Last week, we continued to see positive momentum in mortgage rates. Despite a stronger than expected jobs report the week prior and a hotter than expected PCE inflation reading, bonds rallied and rates started this week slightly lower. That's an encouraging sign for buyers as we head deeper into the spring market. As seems to be the case almost every weekend lately, geopolitical developments also made headlines. The Supreme Court halted the tariff increases implemented in 2025, which triggered volatility in the markets. The Dow Jones Industrial Average dropped nearly 800 points to start the week. At the same time, economists are closely watching rising tensions involving Iran as negotiations remain at a standstill. There's a lot to unpack from last week, so let's dive into what moved the markets and what it could mean for real estate moving forward. Here are your headlines. December's personal consumption expenditures, or PCE data, showed inflation came in slightly hotter than forecast. Headline inflation rose 0.4% for the month, pushing the annual rate up to 2.9%. Core inflation, which excludes food and energy, also increased 0.4%, bringing the annual core rate to 3%. One factor driving inflation: higher costs for video streaming services, which jumped 19.5% in December, adding to monthly price pressures. So, what is the bigger picture? The Fed is still balancing risks. Inflation remains above its 2% target, arguing for a cautious approach on rate cuts, while signs of a cooling labor market could increase pressure to ease policy. Fed Chair Jerome Powell has emphasized there's quote unquote no risk free path. Looking ahead, annual inflation readings could improve in the coming months as higher readings from January of 0.31% and February of 0.45% of 2025 drop out of the 12-month calculation. If new monthly numbers are moderate, we could see a drop in annual inflation. Now, in housing news, home construction improved month over month in December. Housing starts, which measure new homes breaking ground, rose 6.2% from November to an annual pace of 1.4 million. Even so, that's still 7.3% lower year over year. Building permits, which signal future construction activity, increased 4.3% month over month to a 1.448 million annual pace, though they remain slightly below year-ago levels. Despite the uptick, builders remain cautious. The National Association of Home Builders Housing Market Index dipped 1 point in February to 36. A reading below 50 means more builders view conditions as poor than good. Builders continue to point to affordability concerns and higher construction costs as challenges, although lower mortgage rates have been a positive development. So why does this matter for us in real estate? There still aren't enough homes available to fully meet buyer demand, and increasing supply is a slow process. Even when construction activity improves, it can take months for new homes to move from permits to completion. That imbalance between supply and demand could continue to keep the market competitive in the months and the years ahead. The first estimate of GDP of Q4 for 2025 showed the U.S. economy grew at an annualized rate of 1.4%, down sharply from 4.4% in Q3. The drop was driven in large part by cuts in government spending during the shutdown. And initial jobless claims fell by 23,000 last week to 206,000, though the drop may have been influenced by holiday travel around Valentine and President's Day, which can delay filings. Meanwhile, continuing claims rose by 17,000 to 1.869 million. The fact that continuing claims have stayed elevated for some time continues to show that many unemployed workers are taking longer to find new jobs. As we continue pushing deeper into the spring buying season, the big question is whether rates will continue to cooperate. We've seen some encouraging momentum recently, and if inflation continues to cool and economic data stays balanced, there's a real opportunity for rates to remain on their side. This week brings several key reports that could influence that direction. On Tuesday, we'll get home price updates with Case-Shiller and FHFA, which will give us a clearer road on national price trends and appreciation levels. Thursday's jobless claims report will give us an updated read on labor market strength, and any signs of softening could help support mortgage bonds and mortgage rates. Then on Friday, January's Producer Price Index, or PPI, will provide fresh insight into wholesale inflation, which could influence rate movement heading into next week. In short, it's another data-heavy week, and as always, I'll be watching how the bond market reacts and what it means for mortgage rates and buyer activity here locally. Have a great rest of your day, and I'll be in touch next week with another update.